much for joining us today. I'm Sam, and I'm going to be your moderator throughout this presentation. In just a second, we will be joined by Tyson Mavar, one of our senior financial advisors. He is a Chevron-focused advisor, and he is going to be covering an interest rate update as well as going over some factors you should be considering when deciding whether to take a lump sum or an annuity option when you decide to retire from Chevron. Before Tyson comes on, I'd like to just quickly remind you we are not affiliated nor endorsed whatsoever by Chevron. We're a completely independent group of financial advisors here. And after his presentation, he will be answering some of the more frequent questions we've received lately from other Chevron employees. I invite you to stick around if you're interested in listening to those. If you find you have a question while he's speaking, please feel free to enter it in the Q&A box. If we don't have time to answer it live, I will field your question to a Chevron-focused advisor, and they will address you through email or phone. But no one ever goes unaddressed, I promise. And without further ado, here is Tyson Mavar.
Good afternoon, everyone. Thank you for attending our webinar series today. My name is Tyson Mavar. I'm one of the Chevron-focused retirement advisors here for the Retirement Group. And on today's webinar series, we're going to cover some very important information related to the Chevron pension plan. Most of you that work at Chevron will be entitled to a pension benefit of some sort, whether you're on one of the old legacy defined benefit plans or the newer cash balance plan will be a function of when you started with the company, whether it was before or after 2008 specifically. And depending on which company you started with, Chevron, Gulf, Texaco, Caltex, Unical, it's going to define how your pension formula works, as well as some special benefits that you might qualify for and which options you could take on your pension. So we're going to talk about what we believe to be the most important information for an individual approaching their retirement from Chevron Corporation. Those of you who aren't as familiar with us, the Retirement Group has many years of experience working with Chevron employees in helping folks to plan for and transition into retirement. We have hundreds of clients, many of whom come from Chevron, some who are still working at Chevron. Our hope is that you consider doing some business with us as we manage retirement assets for corporate employees, Chevron being one of the companies who we have a long history of helping people retire from. And a whole host of complementary services we encourage you to take advantage of. The retirement cash flow analysis we found to be a very good exercise for people approaching their retirement date to help you pick a good retirement date, to pick a good pension option given all of the circumstances that you're going through. To reallocate, potentially rebalance your 401k plan and take advantage of the options that you have within that plan to be tax efficient once you start taking assets out of those accounts. And there's a variety of ways that we can help you on a complimentary basis prior to your retirement. Just reach out to us and let us know a little bit about your situation. We'll do our best to point you in the right direction. Whether or not you are a client of ours yet, we hope that we can help you improve your retirement experience whenever that time comes for you to leave the company. We also have a LinkedIn page where this webinar will be published later, and many other webinars, some specific to the Chevron retirement process, others specific to things like estate planning, investment planning, tax planning, and a variety of other good topics, content that we think is relevant to somebody approaching their transition from Chevron. So one of the biggest decisions you'll have when you leave Chevron is how to take your pension. And this is not an easy decision. It shouldn't be an easy decision for anybody because it is irrevocable. It's very important. It's very difficult to pick an option with a high degree of certainty that will maximize your earnings or your benefits from the company, because we don't know how long we're going to live and we don't know how well our investments are going to perform. We also don't know what inflation is going to be like in retirement. All of these, as well as some other variables, will play into what's likely going to get you the most money from the plan. And it might not be you, but you and your family, the most money from the Chevron pension plan. The lump sum has been very popular for a number of years, but with climbing interest rates, we've seen lump sums fall pretty dramatically over the last several years to where less people, in my experience, are certain that they're going to take a lump sum. In other words, more people are considering more strongly some of these annuity options. The silver lining, of course, is that interest rates are higher, so we can earn a higher rate of interest on things like fixed income investments than we could have a couple years ago. So there are benefits to taking a lump sum that there weren't a couple years ago. But a lot of different circumstances that we would encourage you to talk through with not only your family, but hopefully a trusted advisor that you feel confident has knowledge in these different options and a lot of different success stories to share with you on which options were good for other people that were in a similar situation as yourself. So in addition to the lump sum, there are a variety of annuity options wherein the company will pay you a monthly paycheck for the rest of your life in all of these cases. But there's a variety of additional benefits you can attach to your annuity that also come with their cost. So let's go through them. The single life annuity, this is going to be the biggest monthly benefit. Once you, the employee or retiree, passes away, the benefits stop. Joint and survivor annuity option. This is an option that the company will pay a lifetime pension for 2 lifetimes, usually spouse as well as the employee, but not always, doesn't have to be your spouse. And whoever your joint annuitant is, whether or not it's a spouse, their age and as a result life expectancy will play into the benefit payout options for the joint and survivor annuity. In other words, if you have a younger spouse or a younger joint annuitant, it's going to reduce your income, both yours and your joint annuitants, because of the longer life expectancy that you and your younger joint annuitant has. There's also a variety of methods to take this joint annuity option. You could take the 100% joint and survivor option, which is going to create zero change in income for the surviving spouse or for the surviving annuitant. But it's going to result in the largest haircut during your lifetime as the retiree to offer that insurance. And you can reduce how much your joint annuitant receives to increase what you receive during your lifetime. So a lot of ways to slice this up, and it's going to typically be a function of does your spouse or joint annuitant have other assets of their own or benefits of their own? If you have a spouse who doesn't have a pension, you may lean toward closer to the 100% joint annuity versus maybe your spouse has a pension, but it's half the size of yours. Maybe you go for the 75% or 50% joint annuity. A lot of ways to slice this up, but we encourage you to run a cash flow analysis to incorporate all different assets and income streams and start to make some thoughtful decisions about which option could make the most sense for you and your family based on your resources. You also have a life and term certain option. Could be 5, 10, or 15-year term certain. What that means is that you're going to get a lifetime paycheck. We know that. It's going to be a little bit less, though, based on having a death benefit associated with you passing away in some period of time of your choosing, 5, 10, or 15 years. The longer term you choose, the more it's going to cost you, or the lower your monthly pension is going to be. Not all that popular in my experience, but we've seen some people take this option who felt a little less certain about their life expectancy. Cancer survivor, in one story that's coming to mind, wanted to make sure, and she was not married, wanted to make sure that her children would have a death benefit if she suffered an untimely death early in retirement. And this is one way to do that. You also have this uniform income option, which I would say is the least popular in my experience, because what it does is gives you more income in the early years of retirement until Social Security eligibility, and then less income beyond. This I could see being popular for somebody who maybe didn't save any money in their 401k or outside of the plans, because you really need a bridge to Social Security, and also assuming you retired prior to 62. But for most people that I work with, they'll have some money in the 401k to bridge the gap. In other words, just withdraw more money from the 401k in those first few years of retirement, and then reduce what you're pulling from the 401k after you start taking Social Security. But certainly one to be considered, and you may just choose because you want to do more things in the early years of retirement and just want to have some extra taxable income in those early years. But it really has to line up not just with your goals and objectives, but also your tax bracket status, especially in those early years of retirement. Then of course we have the lump sum, where you have control of the investments, control of the spending rate or withdrawal rate, complete control over this, where the money goes. Does it go to a custodian like Fidelity or Schwab, which is who we use at the retirement group for our clients? Does it go to an insurance company where you buy your own annuity? Does it go into your bank account? You can do that, but there's probably going to be some tax implications that you might want to avoid. And then it's up to you to be disciplined with this money. So that's another caveat of the lump sum, is that it does have, uh, it is finite. It's going to run out at some point, hopefully not during your lifetime, which is something else we want to identify in the cash flow analysis. But you have more flexibility with it. So there's merits to all of these options. Choosing the right one is a personal decision, one that we encourage you to employ those closest to you, spouse, children, trusted advisors in your circle, maybe somebody like a retirement group advisor or one of our peers in the industry. Because it's irrevocable, it's a big decision. We encourage you to spend quite a bit of time on it well before you get to the point of decision-making time at retirement. Now, there could be some age penalties on your pension. I'm going to zoom in this slide so we can dig into what it's telling us. Toward the top here, you can see the total points at termination, or when you leave the company. This number gets locked in. Points are your age plus your years of service. Most people fall into this far right column. You can see we have it highlighted. It's greater than or equal to 55. So somebody who they could leave at 45 years old with 10 years of service and still be in this column. Everything to the left, everything to the left is further discounted. So we encourage you to at least get your 55 points, and most people will typically get there. But if you don't, the discounts are going to be greater. Now this the y-axis here, the far left column, is the age at which you start receiving benefit, or your benefit commencement date. Not necessarily when you left the company, but when you start benefits. And you do have the option to defer your pension. You don't have to take the lump sum or the annuity right away. In some cases it could make sense, in part because of these age penalties that we see here. And especially if you're somebody who didn't get the 55 points, it might be a very big benefit to wait on your pension based on the growth rates that we see in here, guaranteed at least by the full faith and credit of Chevron. Let's assume you do fall into the far right column here. Let's say you're retired at 50 years old with 5 years of service or more. You could, let's say, retire at 50 years old with 5 years of service. You can see that person would walk away with 50% of their pension. And then every year they wait to take their pension, it's going to grow by what looks like 5%. But going from 50 to 55 is actually an increase of 10%, as it turns out. So if it was $1 million at age 50, it would be 1.1 million at age 51. So that's a pretty decent growth rate compared to what you can earn safely outside of the pension plan, and probably be something to consider. Typically, we'll see people leaving the company in their mid to late 50s, if not into their 60s, in which case there are still age penalties. In this far right column, there's going to be age penalties, as you can see, until age 60. So that's a pretty common goal for a lot of people we work with. Make it to 60. If you leave the company before 60, maybe you got a package, maybe you found a job elsewhere in the industry or in an entirely different industry. Maybe it was a transitional job that you worked part-time to ease into retirement. All of these are common scenarios. You can see that that 5% growth is going on every single year, which, like we talked about earlier, turns out to be more than 5% growth when it comes down to it. And this could be a reason to work till 60, but it's not necessarily a deal breaker to retire prior to age 60. And if you do retire prior to age 60, it's not certain that it makes sense to wait to take your pension either. For example, if you left at age 59, you could take your pension at 95% or wait a year to get 100%. That comes out to just over 5% growth. Well, now in the current environment, CDs are paying more than 5%, short-term CDs. So you have a good alternative outside of the plan. But what's more important in many cases is what's happening with interest rates, especially if you're planning to take the lump sum. If interest rates are going down, you're going to benefit from waiting to take your pension. In many cases, not all cases, but many cases. Again, assuming that you're planning to take the lump sum. Now, if interest rates are going up, even if you're not age 60, you may still want to consider taking your pension prior to age 60 because you could be losing money on your lump sum as a result of rising interest rates. So it's very important, because these interest rates change on a monthly basis, to pay very close attention to interest rates and at least look at them on a monthly basis, not only once you retire, but well before you retire as you approach your retirement date. And it could mean that those interest rates actually determine your retirement date. We've had many clients leave on a specific day to avoid tens of thousands of dollars in losses on their pension. And in some cases, you could be working for free if you're planning to take the lump sum and rates are climbing toward the end of your career. Nobody wants to do that, at least in my experience. This is something to pay close attention to, because it could be tens, if not hundreds of thousands of dollar difference in your total net worth once you leave Chevron. Now we do have the updated interest rates. I'll zoom this one in as well. You can see here we have the March, April, and May interest rates. We're showing these in white here because these are the rates that will predict the August blended rates. They are going to take an average of each one of these segments, which, by the way, are based on short, intermediate, and long-term corporate bonds. The first segment being short-term bonds. You can see the rates aren't all that much different across the segments. That's fairly rare. Typically, the longer-term bonds are higher interest rates than the shorter-term bonds, but we've seen a bit of an inverted yield curve, or at least a flat yield curve, where long and short-term interest rates are pretty close. What we're most interested in, though, is what's happening from month to month to these rates, and as a result, what's going to happen to our clients' pension lump sums. So you can see the August blended rates. All three of these rates are higher than the July blended rates. As a result, somebody who, all else held equal, commenced their pension in August versus July is going to receive less money in their lump sum and may want to consider leaving, and in fact, leaving before July to commence their pension in July, because remember, your commencement date has to be on the first of the month and it cannot be before you retire. So to lock in a July commencement date, a July 1st commencement date, you would have had to have been off payroll by June 30th. And there's a very small window of opportunity, or a crystal ball, where we know what's happening in the lump sum and we can make a educated decision on when to leave the payroll and when to commence your benefit to walk away with extra money. I will say this is not a huge jump in rates, this July to August, but it's considerable enough to where if you were indifferent between your retirement dates, you'd probably want to consider leaving in July versus August to get a little bit extra money and be able to leave payroll a month earlier, if that is attractive to you. So very important based on how big of an impact. With the relationship that we remember is every 1% increase to these rates is about a 10% drop in your lump sum. That is also a function of your age and life expectancy. The younger you are, the more severe the impact increase in interest rates has on your lump sum. So pay very close attention, regardless of your age, to these rates if you're considering a lump sum. If you're not considering a lump sum, not as big of a deal, because the annuity payout, at least for the heritage plans, the defined benefit pension plans, anybody who started prior to 2008, the annuity is not impacted by interest rates. Now, the cash balance plan will be for somebody who started after 2008. That is also important to pay attention to rates for that one, but just stay informed on what's going to ultimately help you to leave the company with the most amount of money. That's at least our advice. Unfortunately, what we found statistically, 74% of Americans over the age of 50 don't even have a written plan for their retirement. And we think this is just unacceptable, folks, given that there are many advisory firms like ours, including ours, that will put together a comprehensive cash flow analysis for you for free in an effort to get to know you and hope that you consider doing some business with us once you leave the company, assuming that you use an advisory firm in retirement. All of these services are complimentary until the point that you decide to open an account with us, whether it's at Fidelity or Schwab. We don't care. Choose your custodian. If you like working with your representative, myself, and the number of people that I work with here at the retirement group, we hope that it's a good fit, but if it's not, we're not going to encourage you to do business with us if you have a better fit elsewhere. The first starting point, though, is to have us run a cash flow analysis, take a look at your Chevron stock, especially if you have any ESOP shares that might qualify for net unrealized appreciation and potentially some pretty lucrative tax savings in many cases. These are the things that we can help you with before retirement. So please just spend a few minutes with us, and we're delighted to spend a few minutes with you as well. How to reach us: you can email us at info@theretirementgroup.com. You can call us at 800-900-5867. You can even take a picture of this QR code here at the bottom and get onto mine or one of my colleagues who knows the Chevron benefits plans calendars, or just follow us on LinkedIn. If you just want to get more information as you approach retirement, that's a great way to do it, is through our LinkedIn account, where we'll publish both specific and non-specific Chevron retirement content that we find pretty valuable to most people that work at Chevron. With that, we're going to wrap it up today. Everybody have a good, safe rest of your week. We hope to talk to you all very soon. Thanks again.